All right, welcome back to Roundtable Prime 2025 from DoubleLine's offices here in Los Angeles. This is segment 2, where we're going to talk more market implications of the previous discussion. But first, at the break, Mr. Rosenberg came to me and said he has some comments about the last section and would like to start off with that before we go into markets. So, Dave, the floor is yours.
Thanks. Well, I was first going to say to you, Jeffrey, that this coffee is so good that you're going to put Starbucks out of business, but then I realized it is Starbucks coffee. But so look, I just have to, I feel compelled to make this comment because we spent like a half an hour talking about Donald Trump. And I guess when I read the FOMC minutes, I think that half the FOMC meeting back on December 18th was all about Donald Trump. So we've really morphed from a fixation on Donald Trump to an obsession with Donald Trump. I just want to offer up that he has a mandate, but it was no landslide victory. That was not a landslide. We've seen landslides in the past. This was not a landslide. But what I want to say is that, you know, I'm giving a presentation next week, and I put together a whole new slide package. And my head of sales says to me, well, there's no Trump in here. So what was he going to do? Put like a picture of like fog? Like what was it going to do? There's no Trump slide. What are we supposed to do here? We're supposed to be forecasting around what Trump is going to do or what Trump is not going to do. And I never make prognostications, whether it's market or macro, based on politics. Okay? Because usually the people that do that get it wrong. You know, what would we have said in 1968 when Richard Nixon got elected, that he was viewed as some right-wing nutbar, and he was probably, I would argue, one of the most progressive presidents of the past century. What we say, Ronald Reagan was supposed to create the conditions for World War III, and instead we ended up having the breakup of the Soviet Union. We're supposed to get under Ronald Reagan, smaller government, but in reality, we got bigger government and bigger deficits. You know, we can go on. Bill Clinton was this radical socialist from Arkansas. And who ever thought, now maybe it's because he had another Treasury secretary that was influential named Bob Rubin, that he would push Bill Clinton to the right of center, and we would get tax cuts, we would get deregulation in telecom, 3 strikes and you're out, welfare policy. Who thought that Bill Clinton would ever do that? George W. Bush comes into power, and he was supposed to be running against Al Gore on pulling back the U.S. from the global arena. And the next thing you know, because we're overtaken by events constantly, that we're fighting wars in Iraq and Afghanistan and so on and so forth. Then we talked about Barack Obama, transformational president. We can argue Trump is a transformational president. And as Charlie said, Obama was his first 2 years, and then it was nothing for the next 6 years. What is it that we're supposed to be doing here, talking incessantly about Donald Trump? So I remember when he got elected the first time in November 2016, Larry Lindsey. And who was smarter than Larry Lindsey? Card-carrying Republican, was on the Greenspan Fed. The very next day is on CNBC, and he says, we're going to have inflation/reflation, and interest rates are going to 6%. Now, I quite understand with this backup in the 10-year note yield, we're at 460, 470. We're not at 6%. This is going back to 2016. He was dead wrong. He's the smartest guy in the room on Trump's policies. So, I don't understand this obsession, fixation. I don't know. Hopefully we're not going to talk about it again. Maybe we will. I don't know. When I read those FOMC minutes, I was profoundly disappointed because on November the 7th, 2 days after the election, Powell tells us that the Fed is not in the game of speculating on politics or what Trump is going to do or not do. And I said, good on you. 6 weeks later, what's it called? What did he call it? A policy placeholder. And we're not going to cut rates. It's all about tariffs. And how do they even know? They're now running their models based on tariffs, and we don't even know what they're going to look like. Is it negotiating? Is it bargaining? We don't know. We don't know. It's just, I understand that when we have a new president coming in, we have to pay attention, but there's just degrees. And I think the attention on what Trump's going to do or not do, we've reached, and even here, I think we've reached a bit of an extreme as to moving from fixation to obsession. And so, as Forrest Gump said at the reflection pool, that's all I have to say about that.
You don't like that 51st state thing.
I would be happy to trade in my loonies at a 45% premium. Absolutely. Sign me up.
I liked what some Canadian politicians said. I'd actually supported it. They said, why don't we make some of these New England states part of Canada? And I'm thinking, there's a good idea.
Well, they have our same weather patterns, so we're at that in common.
Same politics.
All right. So that's all Rosie's got to say about that. So, well, let's pick this up. Jeffrey, I definitely want to start with you on this. You mentioned, the government deficits. You put out the piece in The Economist recently about it, trying to really break it down more for the layman, right? Just break it down to very simple building blocks there. So we're talking about markets now. What are the implications for treasuries? And what do you see? How is this going to play out? Is it a 2025 phenomenon? Are we already seeing some of that play out? Is it a longer term? Is it the next recession? How are you thinking about this, and when does it matter?
Well, it's starting to matter in real time as you look at the interest expense on the debt, which has gone from 0.3 trillion to different numbers you see, but over $1 trillion a year. And that's going to keep on going higher with the deficit not going down. And of course, whenever a recession comes, and that's been delayed through all of these volatility of the money printing and so forth, and now it's going to be further perhaps volatility with policy changes, whatever they might be. But I think when I say it started with the Treasury yield curve steepening. And we thought for 2024, the most obvious trend to be wary of and looking for was the de-inversion of the yield curve. And it's happened to us to an extent that is not insignificant, 150 basis point switch. But I don't think it's complete. I think we're going to see more and more issuance at the longer end, and I think there's going to be less and less acceptance of it, and those rates might go up. And it's interesting to look at the pattern of returns for 2024, because 2-year bonds had a gain, and as you go out the yield curve, it gets less and less. And if you actually did it on a duration neutral basis, it's pretty substantial differences. And I'm quite confident that has legs in almost a secular sense. And so when you think about that, you might want to think about discount rates and how those apply to other markets. And I observe historically that way more than should happen on a statistical randomness basis, you get trends to exhaust and often reverse right around the end of the year. And I'm of the opinion that this change in the interest rate structure is going to change some of these trends of there's a sense of invincibility in the markets today, that the lowest investment grade spreads since pre-GFC, very low high yield spreads, that there's no possibility for them to expand. And I will acknowledge that the credit quality of investment grade is quite good. And I will acknowledge that given the credit quality of investment grade is good and the way the government finances are being handled is not so good, corporate bond spreads probably should be fairly tight until such time as the economy weakens. You can say the same thing for junk bonds.
So historically in like EM countries where the corporate trades through the sovereign, right?
Right. Well, that happened in the United States when I started in this business. There were corporate bonds that traded for the same maturity, a yield lower than treasuries. There were companies like IBM, AAA, and they were thought to be a lower of a risk than the treasuries. And I think that mentality is building. So I also think with the changes at year end, I think another thing that's perceived to be invincibility is this forever trend trade of, Magnificent Seven, growth and value, U.S., non-U.S. Almost all of these things are at double tops versus very extreme blow-offs at past bubble periods like 1999 or 2007. And I think that's a very, very bad assumption to be making. going into 2025. These trends are invincible and can't be reversed, because if you believe that trends are invincible, take a look at a chart of the relative performance of the S&P 500 to the ESG, the green component of the S&P 500. 3 years ago, all you got were questions on ESG and how it's doing so great, and it's the investment of the future. And of course, it was analyzed using a backward-looking analysis where funds were being irrationally allocated into ESG, pushing up the prices of ESG, motivating people or getting people excited about the continuation of that trend. Well, that trend in the last 2 years, the ESG component is down 40% and the S&P 500 is up 60%. So if you think trends can't reverse, you're not paying attention to what was the fate of the most recent fad of lemming, crowding, herding behavior. And so it may take a while, but I think that those trends should be avoided. Also, some of these graphs of like U.S. versus the rest of the world are pretty remarkable. You can go back decades, and the valuations there looked very high in 00 and very high in 08. We're off the charts versus those valuations. And I would apply the same logic to that the idea that this is going to the sky is very unlikely to be your best idea.
Yeah. So, Jim, you brought up the idea of a structural change of inflation. Jeffrey's talking about a steepening yield curve. Isn't it also rational to think that the yield curve should steepen if indeed we have higher policy rates, right? If that higher inflation leads to a higher policy rate, and in normal times we should command a term premium, right? Wouldn't you expect that to be some of the driver from your seat as well?
Yeah, I mean,
I'm not trying to put words in your mouth, but
no, yes. I mean, what we're talking about is a bear steepener in the yield curve. A bear steepener means the yield curve steepens in the face of higher interest rates, and it's uninverted via the long rates going above the short rates, and that is somewhat unusual for the yield curve to uninvert and steepen that way. Normally, it steepens in a falling rate environment with short-term rates falling faster because the Fed is panicking that the economy is weakening and going into recession, not with rates rising and long rates rising faster. That, to me, has been an inflation trade, is that we're putting in, with rising term premiums and bigger real rates, we're putting into the markets more risk of potential inflation. And that gets to what Jeff said in the first session, that what we've seen happen since the middle of September when the Fed cut 50 basis points is the 10-year yield has gone up 100 basis points while they've cut 100, and that there isn't really any examples, or maybe 1981 when they came off of 20% and long-term yields went up, and Ed Yardeni coined the term barn market vigilante to basically describe that period. That might be the only example that we've got of what we're seeing with this divergence in rates. I think it's all about the idea about, or the fear of inflation. Maybe it doesn't manifest, but it is definitely a fear, which is why you've got this bear steepener. And what's driving that? The idea that the economy, 9 of the last 10 quarters, has grown at least 2.5% top line. Yes, it's a K-shaped economy. Yes, underneath there's a lot of issues. But the top line is growing at 2.5%. That's above its potential, meaning that it's fully, that's what you should expect out of the economy.
Well, like during the post-GFC to the pandemic, I think it was like 2.3% was the annualized growth rate of that period.
Right. And now we've got...
That's why you talk about above potential.
Right, yeah. Above potential. So now we've got like 9 of the last 10 quarters that are above that. Now we got Trump coming, and I know we're not trying to be obsessive about Trump, but that's fiscal stimulus, that's tax cuts. That's going to put a tailwind to the economy. Then you throw in the Fed is cutting rates. The market's going, wait, we don't need this. We got enough already. All this is going to do is produce fears of inflation. And you see that in shorter term TIPS inflation break-even spreads at 2-year and the 5-year tenors, that they're moving up. And that's why the more they talk about cutting rates, the higher long-term rates are going to go. And I think that that's really what we've got. You add it all up, and we've got this unusual situation of the bear steepener with rates going up and long rates going up faster.
The economy is growing above potential. How is that consistent with the unemployment rate trending up and the industry capacity utilization rate trending down? How does that compute? Because if the economy is growing above trend, the unemployment rate should be going down, but it's no longer going down. So how do you reconcile that?
Let's start with that the unemployment rate of 4.3, 4.2 is fairly low to begin.
No, but it's not about the level. It's about the change.
Right. Let's throw in another factor too. The population growth in the United States is the fastest it's been in 30 years. It's growing at about 1.15% through the end of 24. It is 80% of that population growth is being driven by immigration. The vast majority, I don't want to say the vast majority, but more than 4% unemployment is coming from those immigrants. In other words, the immigrants that are coming into the country don't have jobs. And that's what's pushing up. The population growth of this country is the big driver in a lot of these data. It has done a complete U-turn from where it was, say, pre-pandemic to where it is now. We're importing 4 million people a year into the country, and we're importing more than a higher than 4% unemployment rate among those people that are coming in. It's getting picked up in the surveys, and it's pushing up the unemployment rate because you've got the unemployment rate rising, and we're not anywhere near a negative payroll report. It's not like we're contracting jobs. We're still creating jobs. We're not creating them fast enough, which is why we hear that there's, the natural, how many jobs do we need for the demographics of the country, that on the long term, it's 75 or 100,000 jobs that we need long term in order to satisfy the needs for the population growth. But in the short term, the next couple of years, it's like 250 or 300,000 jobs. It's the flood of people that are coming into the country. So don't confuse the rising unemployment rate as a signal of the economy weakening. Think about it more as it's telling you about the population growth in the country.
I didn't say the economy is weakening. I just went back to say, why do you think the economy is growing above trend if labor market slack is rising? That's all I asked. I didn't talk about, the unemployment rate comes from the household survey,
right,
which hasn't created any jobs in the past year. So it doesn't come from the payroll survey, and half the growth in the payroll survey is coming from the birth-death model. But let's put that aside. I'm not talking about how weak the economy is. I'm talking about how do you reconcile the view that the economy is growing above potential at a time when the employment rate is trending higher?
I guess what I was trying to say was that I think the employment rate, what you're asking me is to tie the unemployment rate and the growth of the economy together, and I'm trying to separate them.
No, I didn't tie it to the growth in the economy. I talked about why do you think the economy is growing above potential in the context of a rising unemployment rate?
Well, I could tell you why I think the economy is growing above potential, and I just said why I think the unemployment rate is rising, but I don't think that, you need to have one unified theory to explain both of them at the same time. That's what I'm trying to say. The unemployment rate is somewhat decoupled from it. The measure of the unemployment rate is about the measure of the growth of the country, population of the country. It is not an economic indicator as much as we used to think it was.
No, Jimmy, if you look at the JOLT survey and you look at the firing rate, the hiring rate, the quits rate, and the opening rate all combined, it's consistent with a labor market that is creating economic slack. So even if you want to go beyond the unemployment rate, there are many other measures that are confirming that labor market slack is building, which is not consistent with an economy that's growing above trend.
Well, maybe some of that, and I'm not trying to get the wrath of you, David, is that if you look at the incentive for job switchers versus those who stay employed, it's the lowest level we've seen in a couple of years as well. And so maybe that's why you're seeing some of that quits rate down a little bit as part of it, because there is a lot of co-integration across those statistics.
Yeah, but I think that reflects job insecurity rising to the same degree that it has. Remember, we're finding out right now how bad of a job. Our bureaucrats make circa USSR ones look brilliant and honest. When you find out that in the year ended June 30, 2024, the private sector really didn't create 2.4 million jobs, but it actually created 1.2 million jobs. And you look at the trajectory of the revisions going forward, and this is something I've talked about with Bloomberg's Anna Wong, it looks like payroll losses, once the dust settles on the revisions, had started in April of 2024. That once we finally see all of this come through, the Bureau of Economic Analysis came in after that quarterly census of employment and wages and took down second quarter personal income for the country by $91 billion. And what was left over was $65 billion. When you see the magnitude of revisions that we saw in 2001, that we saw in 2007 and into 2008, And we're seeing now, I think it's very difficult to say with any certainty that there's increased security in this job market. And in fact, especially when you consider the fact that back in 2007, 2008, there was no gig economy. Uber was born in Paris in 2009. We have part-time unemployment for economic and non-economic reasons right now at the highest level since it was in 2010. Why is that? Because people aren't applying for unemployment benefits. Why would they? Making what, $300 a week? They're like, I can go drive for Uber and make $1,000. So we haven't had that shock absorber for the economy that's been absolutely tremendous. And by the way, to your point about immigration, I have not gotten in an Uber or a Lyft in Dallas in weeks and not thank God that I speak Spanish.
Well, if they're making $1,000 a week, you sign up for some of this, as a side hustle,
I'm sympathetic to thematically what Jim's talking about, which I used to phrase parallel lines meet in a wiggly world, which means you can't. It's why regression analysis for looking toward the future doesn't work. The coefficients are not constant. They change, and you don't know how in which they're going to change. And what you're talking about is this demographic thing is it's a wiggly world. And I think that I am sympathetic to that way of thinking because, again, I think that in a secularly rising interest rate environment, especially at the long end, you cannot map over the relationships of the secularly declining interest rate environment. And I would say it's been made even more wiggly by all of this stimulus and now perhaps cutting or perhaps tariffs, who knows, that we're talking about. So the thing that, when you talk about the inflation rate, I don't really think the inflation rate that people in our industry talk about and the Fed talks about is what's really bugging people down in the real world. They don't like the price of eggs is still $18 for 20 eggs. They're used to it being lower, and they can't afford it. To them, it makes no difference if the inflation rate for the next 2 years is 2% per annum or 3.5% per annum. It's already just the price level cannot be afforded.
The cumulative increase is
yes, it's still massive. We've gone from a 2% trend in most inflation measures for the 20 years previously to 2020 to suddenly it's spiked up tremendously with the M2 money supply, which I know Dave is very familiar with, and the M2 is shrunk a little bit, but it was still at a very high level versus trend, and it's still not to that trend level that it was.
But why is that different than from what Volcker inherited? After 10 years of rampant inflation, 10 years, not 18 months, of rampant inflation in the 70s. Paul Volcker is revered for being the inflation dragon slayer, but with all due deference, he never brought down the price level. The price level never went down in Paul Volcker's 7-year tenure. He slowed down the rate of growth. The price level kept on going up. The price level is keeping on going up. What's different? What's different? We talk about the 1980s was a period of rampant disinflation, and we tip our hat to Paul Volcker for accomplishing that. But we don't say, well, Paul Volcker presided over a 30% increase in the price level during his tenure.
But he instituted a 10% real interest rate, a 14% real interest rate. That's what's different. We have a real interest rate now. At least it's not negative, but it's not double digit.
We had 10 years of inflation. We got inflation. I cannot even believe that we're still talking about the inflation that in the overall annals of economic history was 18 months. Okay. I can understand going into the 1980s, we had 10 years of inflation. Okay. And now we're just talking about inflation. We had 18 months of inflation, and God forbid for a few months we settle in close to 3%. We have a new secular inflation trend. From what? It doesn't make any sense to me. But, everybody talks about the price of eggs. Well, that's a supply shock, okay? And a lot of the other things like cocoa and coffee. What other commodities are hitting new highs? 4 commodities have hit new highs: orange juice, cocoa, coffee, and eggs. But we didn't talk about what cotton's doing, and we didn't talk about what iron ore and copper and aluminum have been doing, but eggs, and we know why egg price has been going up. And unless Jay Powell wants to start some chicken farms, there's nothing the Fed can do about the price of eggs, okay?
One thing I like about Jay Powell is he says things like,
if you take out the data you don't like,
Wait, you had my attention there for a minute.
if you take out the data you don't like, like
Bob Ross,
I was going to take notes.
like to paint your own picture. Yeah, but yeah, that have a cloud over there, put it there.
Thinking objectively.
Yeah, but I think that was Jay Powell in Dees of 2018. That was a happy mistake, right? That he said automatic pilot.
in here. Put her
All right.
burger.
So you guys have all digressed. You're not achieving the objectives. We want to talk markets. Jeffrey started off okay. We got out of fun. We're back on inflation again. Someone's going to say the T word, and then Rosie's going to spell them out.
Nope.
So what we need to do here is bring it back. So Danielle, you've written a lot about corporate bankruptcies and a lot of signals you're getting, some in commercial real estate, a lot from the bottom up. 2024, to your credit, was a record year in bankruptcies.
Yep.
Some of it gets absolved. As our credit folks in the leverage finance say, there's a lot of creditor-on-creditor violence, meaning that there's debt exchanges, bad company takes a bad company, levers it up more.
Before you move on, twice the number of distressed debt exchanges as bankruptcies in 2024, which is basically a bankruptcy and drag.
Right? I don't know if we can say that in California, but that being said, I'm glad you have your Texas roots. So, but the thing is here is that if you look at it, some of this is also being masked by the private markets, right?
Oh, gosh, yes.
Yeah. So where are you shaking on this? What are the implications as you think through debt markets as a credit investor? How are you thinking through that, and what's that telling you? See what I did there? Got us off inflation.
So during the break, I was actually talking about the extraordinary growth that we've seen in non-depository financial institution loan growth. Okay, so past 5 years, inflation adjusted 10% growth per annum, inflation adjusted in NDFIs. All other lending outside of this, flat as a pancake.
Yeah, but is that primarily private markets?
A lot of it is going into private credit. So private credit was a decade ago, $500 billion. Now it's 1.5, 1.6 trillion, and growing really fast.
They want to take it to $5 trillion in 5 years, is what all the conferences said late last year.
Throw in asset-backed securitization. Apollo said it was going to 40 trillion. So this is actually, to your point, Jeffrey, I think that one of the reasons that we're seeing depressed high yield spreads is because that's not where the risk has moved. And the reason we're seeing a 20-month high in leveraged loan defaults is because that's a little bit more visible, but it's also one step closer to private credit. So a lot of the risk that would otherwise be visible and manifest in high yield spreads today, you can't see it because so much has moved into private.
But don't also forget that the loans are typically floaters, thus they were impacted more meaningfully.
This is not going to end well. And I think that what people need to realize is that there's going to be a feedback mechanism into the high yield market that you will see. In fact, Bloomberg had a great, huge story out today that was saying that high yield spreads right now are like a rubber band waiting to snap. But it's the feedback mechanism from private credit into leveraged loans into high yield that I think is one of the biggest risks, as well as the fact that banks are increasingly impaired. So you've had double defaulting corporate debt. You've had double default.
Define double defaulting?
That means that the same loan defaults twice. So it's modified, it's extended, it's pretended. Identical phenomena has, you've seen a doubling in double defaults in commercial real estate loans in the past few years.
So you're saying, subprime borrowers have that moniker for a reason? They're serial defaulters, right? Yeah.
They're serial defaulters, but the reason I bring this up is because the credit rating agencies are starting to get itchy. They're having a hard time not downgrading. Now the FDIC, some of the other regulators are like, because they can't make bank marriages happen because banks are still sitting on all these unrealized losses in their Treasury mortgage-backed securities portfolios. So try brokering a marriage of that when you can't value the CRE book in a state of double default. So the regulators are saying, don't downgrade, which is opposite what happened with subprime mortgages. So I think 2025.
Well, they were very cautious at first. The subprime, the first downgrade was from AAA to BBB minus.
Right. I think what you're going to see this year is, I think we've kind of reached finally the end of extend and pretend. You saw Ally Financial go boogie right out of the mortgage market a few days ago. Their charge-offs are just through the roof in autos. But you're seeing extend and pretend in credit card books. You're seeing extend and pretend in auto loan books. And Bill Moreland, big shout out at Bank Reg Data, does a really good job with bank call sheets. And when you roll in what's been extended and pretended and no longer counts as part of your non-performing, when you add those two together, these charge-off rates would be double what they are right now. It's pretty astounding. I think 2025 is going to be a year of disruption in the banking system and serious blowback into credit.
Charles, given all of this too, how does this make you think about some of your recommendations and just, as you think about markets as a whole? Obviously, there's winners and losers when we talk about indices and things like that. But do these dynamics come into play as your thoughts of allocating capital within the equity market?
Sure. I mean, for instance, one of the Trump trades was financials.
You weren't supposed to say that.
Oh, one of the new administration trades was financials.
How diplomatic.
And listen, I mean, if you start looking at these delinquencies and these charge-offs, a lot of folks are talking regional banks, maybe super regional banks, small banks. But I'm saying you maybe want to just stick with JP Morgan and the Goldmans of the world, because that part of the discussion is not out there, because I think it's so macro, and we're not going to be at the have Basel III and won't strangle American banks, which I'm down for that. But I disagree a little bit with Jeff, not on the Mag 7 thing, in the sense that this last year, 2024, almost every major Wall Street firm implored investors to get out of the Mag 7 names. And in one period in the summer, it looked like a great call, right? You started to have equal weight S&P come on and some of these other things. But when things got shaky, the de facto safe haven now are the Mag 7 names. And they are different than the past, in the sense that there's never been a group of names that have made this much money, that had this much free cash flow. My last book came out on October 7th, 2023. And I had a whole chapter of NVIDIA versus Cisco. And I wrote, I put all the differences there. And, Cisco was making a lot of acquisitions, and a lot of it was like, just a lot of it was just whatever. This is a unique period in time that it's hard to bet against. In other words, we know, at some point the trade will fail. But I think you have to ride it until it does, because assuming that it will at some point, we've never been here before. We have never had 7 companies like this at all. I mean, just the only thing, it's so funny, in that same book, I wrote a chapter about the roaring 20s and how this, will have a redux. I'm thinking more now we're in the new Gilded Age, potentially meeting the McKinley era. And if this is the case, if it works out the way I think it could, we could be talking about decades of prosperity. Decades of prosperity. And the difference, of course, the only difference, ironically, now with the old Gilded Age and how, the media and portrays the robber barons as these evil guys who took advantage of everyone, it was the exact opposite. They took people off the farms where they lived every year hoping that the crop would come in. Right? If it didn't come in, hopefully your neighbor had enough food to share with you. Right? And people went to these cities and they populated them. Production worker wages went straight up for a century. 1893, Chicago World's Fair, right? The White City. We introduced electricity. We introduced American-style consumerism essentially made its debut to the world, right? You can take a date and go on a Ferris wheel. We had skyscrapers. And McKinley protected technology the way I think Trump is going to protect AI and other things. And I think this is going to be the focus, right? Microsoft's going to spend $80 billion this year in data centers. So it's not all hype, right?
In fairness, did you ever think that we would see a world where these the politicians in the U.S. actually encourage the creating inferior chipsets for the rest of the world? I mean, this is something that came into the previous administration. See, I'm trying to play to Rosie here. And the current one has done it even more. And I assume it's going to continue. But this hindrance of the technology, it's not something we see very often unless it's being defined militarily. But usually that's where it's protected the most.
Think about the Eisenhower, right? In the Highways Act. That was a military act. It had probably had economic ramifications to connect the country. But they presented it to the world as a military act. Look at the Germans, and they have the Autobahn. We have to have that to be able to move tanks around, yada, yada. You talk about demographics being destiny. I think demographics are destiny, and I think short-term dominance in technology is destiny. I'm watching smaller names say, we beat the numbers because we were able to implement this system and that system. We're starting to see the implications of them, even in earnings calls right now. And so I think that's a trade I'm going to ride. Listen, My own personal portfolio, my best play last year was a company called Rocket Labs, right? I paid 6, it's 29 right now. And, you know, space, these little niche things, it's hard to, you know, for if you're managing a lot of money to put a ton of money in those things. But Palantir, Wall Street hated Palantir. I've got this kid, he's like the best software analyst. And I had him on the show like 6 months ago, 5 months ago. I said, why don't you have a buy rating on Palantir? You know what his answer was? Too many retail investors own it. All right. You know, it's like, and I know on paper is the most expensive stock that ever existed, right? I mean, it's up there in every metric out there. But if I'm in this to help people make money, not to be right, I guess is my argument sometimes, because there's a lot of brilliant people out there who want to be right. And, you know, listen, their returns aren't that great. And, you know, for me, my main job with my firm is to try to help people make as much money as possible in the market. Obviously, we manage risk, but by the same token, I think some of the biggest mistakes I've ever made personally was assuming when certain things would stop working. The other mistake is not recognizing when it stopped working, right? So it's a thin line. It's a thin line.
Yeah. I mean, we were talking a couple days ago in a strategy meeting, and it's like, yeah, maybe you want to buy some duration, but it's like, it's a bad chart, right? And so sometimes you gotta respect that trend for a while. Sometimes you gotta hold.
Trends are tough, man. Trends, I mean, it seems simplistic, but they are really, you know, they don't break. They just, you know, when they do, you have to recognize it.
Momentum's a powerful beast.
Yeah.
You know. So Jim, as you think through all this too, I started off with, you know, kind of talking about the bond market here. What are you thinking about on the stock side? What are you liking on that side of the equation? And, you know, also, you write a lot about gold and things as well. Gold had a great year last year as well, right?
Yeah, I'll start with the first part of your question with the stock market and riff off of something Charles said about that we could be poised for decades of prosperity coming forward. In something that I said earlier, when technology comes, it isn't, here's my business model, this is the way our business works, now we'll just unplug these middle management people, we'll stick a computer in, and our margins will go up and everything is going to be great. We're going to have to redefine all these business models. And in that process of redefining all these business models is that prosperity that we're going to come. We're going to make businesses work in ways that were not possible, that we haven't thought of. And a lot of that is going to continue to come forward from here. And that's both, you know, exciting and scary at the same time, because it's the Schumpeter creative destruction is what we're talking about. And that's what leads you to a period of decades of prosperity if you allow it to happen. When you start in on, no, we have to have inferior chips, you're protecting the status quo. That's when you have decades of stagnation. And hopefully we're getting away from that, and we're going to have those periods of prosperity. As far as the stock market goes, I'll say this about the stock market. It's about expectations. And what worries me a bit about the stock market is not that it'll go down, not that you're going to lose a lot of money, but that we have unrealistic expectations that everybody's kind of caught this, I call it the FOMO bubble, right? That you know, something is going to go up 50% this year. A big idea is going to go up 50. What is it? And how do I play it? Because there's always a 50% idea. Well, what about if the markets are going to give you 6 or 7 or 8%? And if I'm right, and we're in a 3% world, and you could keep churning out 6 or 7%, no. I want the 50% idea. I want the 25% idea. To what you asked me before, last year gold was up 25% for the year, and the S&P was up 25% for the year. That is the first time ever both of those returned more than 25% in the same year.
And most people don't realize that gold did it, except the gold bug folks, right?
Right.
You would never, you could win that bet in a bar.
So you've got everybody going, yeah, because everything, so many things go up 25%. Now, I'm talking not individual stocks. I'm talking like sector kind of ideas. So yeah, there's all kind of things that are supposed to go up that much. So what I'm afraid of with the stock market is this expectations game that, yes, you can continue to make money. Yes, you can continue to make money on a real basis, well above the inflation rate. But are you going to double your money every 3 years? That's effectively what a 20 or 30% gain is. No, you shouldn't be expecting that unless you're going to micro ideas of a particular stock or a narrow sector But if you're waiting for asset classes to keep doubling every 2 or 3 years, I think that that's going to be, where the disappointment could come in. And if it continues, then you get into real overvaluation areas, and then you could be, poised for some kind of a pullback in the markets.
You're referencing the survey of consumers. Do you expect significant gains in stocks over the next 12 months? It's like 60% higher than the previous.
Right. That
record high.
conference board.
Well, the other one, though, the
No, this is
AAII, the
your
American
Fed.
Association of Individual Investors, ironically, that's come down a lot. It was 50 in October, and now it's below the historic average. It's like 33%. And that's a weekly survey. So
It's super noisy though, too, right? In fairness,
it's been orderly, that in the last couple of years, it's been really right. I mean, it's the CIO, the investment folks who seem, the professionals who seem a little bit more exuberant than normal to me. That, I mean, my worry is the rotation trade. I love the rotation trade. It's a lot, hey, I can make money at 493 stocks. It makes it a lot easier. I want the rotation trade to kick in, but. So far, it hasn't. To your point, in part, I think, Jim, because people are like, "Listen, we could hit these grand slams right now."
Right, and they're kind of ignoring it. And on the rotation trade, I think that the companies that are not Google or Meta or Apple or Nvidia that are making AI, you're saying, oh, what does it mean for our company that AI is coming? Start with, how do we structure our business? What is our business model supposed to be in this environment? Like I said, I can't emphasize enough that this mentality is, oh, I'm going to buy this computer and I'm going to fire these 3 people and the computer's going to do their job, and that's what AI means. No, it's way, way more than that. And it's both scary and really opportunistic at the same time.
Well, AI is just a massively high-dimensional correlation matrix. It's really what it is. So to distill it down, you brought up 2 25%ers. Of broad asset classes. The China large cap ETF, which is, it invests in large cap in China, obviously. It was up over 30% last year with all of the ramifications of what's going on in China. Usually people have very strong opinions about investing in China. Where do you guys sit today? And that's a jump ball for anyone.
I'll jump in on that one. What happened with China was, until September, it was a giant horror show. China was a sophisticated way to continue to lose money. Then the Chinese government panicked. They announced what seemed to be like a stimulus program a day, and they cut rates. They printed money. They even talked about the idea of a low-tech helicopter. What I mean by low-tech helicopter was they were going to deploy government workers with wads of yuan, their currency, to hand to homeless people so they could spend money to get the economy going. I was like, it's more efficient if you just throw it out of a helicopter.
You were trying to draw the parallel to helicopter money.
Yeah,
right?
exactly.
We did in Vietnam.
Exactly.
Yeah.
Then their market went up something like 25 or 30% in 10 days, right at the end of September, and hasn't done anything since. Meanwhile, their bond market yields are collapsing to the lowest levels that we've seen. As I mentioned, their stock market has stopped going up. Their economy's GDP is, if you take out the periods of COVID and Tiananmen Square, if you take those 2 periods out, they've got the lowest levels of GDP growth in 50 years right now. And Wall Street thinks next year will be lower and 26 will be even lower. I talked about creative destruction. I talked about that, you've got all of these changes coming. China's the opposite of that. They refuse to change. They refuse to put in any kind of a potential policy that would allow any kind of creative destruction. And I think it's catching up with them. And the answer is, well, if we just throw money at it, even that isn't working. The bazookas that they kept firing to try and get their economy going just excited David Tepper and a bunch of hedge fund managers for about 2 weeks that bought their stocks, and then it kind of ended right there.
I think the most interesting thing, and it's a little bit more than a little bit concerning, is what you mentioned, Jim, which is this collapse in their bond yields. I don't think I would have predicted that during 2024 into 2025 that Chinese bond yields would be below Japan's. It's pretty incredible that Japan is now an Asian, in the developed markets, which I call China developed, is a high yielder.
Right.
And, to think that they were nailed at zero forever. And it suggests to me with that yield decline that there's very, very significant reason to be concerned about what's going on there. I think when Charles talks about this decades of prosperity, I think that that's a possible outcome. But I think between here and the decades of prosperity lies the valley. I think we need to restructure a lot of things about our fiscal situation, about our economy, about how the pie gets split up. This goes back to Charles's, 25%, 75%. I'd say it's more like 10%, 90%. And that's an issue that is growing in awareness. And I just can't see how we can trendline our way out of these forward at a certain amplitude without restructuring these institutions. I think that's what we're headed for. I see that. I think that explains just about everything that's happening societally, politically, and a lot of it has to do with, and I'll repeat what I said earlier, this generation that was the greatest time to be born was like 1945. You couldn't lose. The U.S. was the only industrial power. We had tremendous wealth. We had tremendous demographics, and you just threw a dart and you were able to be very successful. But that opportunity doesn't exist for people today, and they need it to make it exist. And I don't think that happens through an evolutionary process.
Yeah, that's what I was trying to say when Dave was talking earlier, was that there was something about that Volcker era too, that so many people didn't own financial assets, they owned housing and real estate, and it benefited from those inflationary environments. So although, you could argue that over the last 4 years, the asset owners have done well on both sides, but I think there's just more vocalization, and people have the Twitter, they have social media, they have ways of getting out there where it's not being controlled by the institution where it was before. With that, though, I want to talk about Japan, too, because you brought up the Japanese yields. Japan's been a very favorite trade for a lot of folks, too, with their idea of trying to do more stimulus there, trying to get a more productive economy. What are your guys' thoughts on the Japanese equity market?
I'll jump in here just because there's a certain lag effect when you start to reduce your quantitative easing process, and I think that's finally going to be kicking in. And I think liquidity is going to become increasingly constrained in an economy where it's had no bounds for decades and decades and decades. So I think the regime shift at the Bank of Japan, I think, is meaningful, and I think we all have to pay attention to the fact that liquidity matters most.
I saw a list yesterday of the most actively purchased stocks in Japan, like in the last weekend. It was Nvidia, Palantir. Listen, these trades, they get hot. Wall Street likes them, and they work out for a while. It's I don't know enough about the individual companies, and I don't. So it's tough for me. It's not. You can ride a certain kind of trading, the popular, and some things start. Success begets success, right? And there's a lot of money sloshing around out there, always looking for the next thing. We talked about the rotation trade not necessarily working here. There's a lot of cash that's not looking to chase the winners, right? And the last few weeks, almost every day, you'll see a few names, even in the top 10 S&P names, that some bottom fishing is starting to happen here. All of a sudden, like, whoa, who's buying that and why? And there's a lot of hunches, right? People want the bottom fish. People are looking for value, and Japan is seen as a great value trade, I think, by a lot of people. I personally just don't know enough about the individual companies driving it.
Okay, that's fair enough. Lastly, things we haven't really touched on. We kind of mentioned gold a little bit, but like this whole concept of alternative assets. What do they mean to you guys? How should people think through them? Are they just, things where we've washed volatility out of? How do you think about alternatives for a portfolio for this year? Or should we just ride the S&P 500 to the moon?
The alts, again, it's, I start to worry a little bit when Wall Street has these sort of niches that they share with the public. It's like, all of a sudden, hey, you know what? You too can get what the big boys have been buying for a long time. Like, why you want me in there now?
I think the greatest revolution for private credit and private equity was taking it from the qualified purchaser, meaning the 5 million liquid net worth, to the accredited investor, which means you have to make 200,000 for the last 2 years.
Yeah,
there's a big chasm there of wealth,
yeah,
right? Yeah. And so I think that is one of the very strong creations that has led to this private credit, private equity revolution. as people are.
And there's some building worries about that too, because it's a lot more opaque than other investments, and so the more popular it becomes, the more money that funnels in there. You're talking some of the numbers you were talking earlier, and it's more opaque. We don't even really have necessarily great pulse. We don't really know what the hell is going on in there. We hear about the returns and the opportunity, but I don't know that everyone understands the risk, or so.
The great news is that the ones that, I buy a couple of funds here and there, usually vintages, just on stuff I would never buy. As Jeffrey says, it's much easier to buy something you don't.
I got a buddy at Morgan Stanley, and he does those for, and I'm like, my man, Ed, stop pitching me. Just go ahead.
Well, and on top of that, it's like, okay, well, I don't take enough risk, so let's just, do it. It's blind. I don't want to hear about it. But I got to say, I was amazed. In 22, my bonds were down a lot. My stocks were down a lot. But my private credit, my private equity, it was flat to up.
Yeah.
So I mean, it's a brilliant investment.
Like a CD doesn't have a price change either.
That's right. You're just hoping it matures. But the problem is you will have a markdown at some point. It just will be minus 100.
But now we've got private credit is now starting to roll out ETFs. So
How is that possible?
We've gone from the accredited, qualified investor to accredited investor to John Q. Public. So what's Apollo keeping and what's Apollo putting in the ETF that they're giving the John Q. Public is really, and what I think has happened largely with the alt space is this is an outgrowth of Dodd-Frank for 15 years ago, which is why we've seen the number of IPOs go down and everything else, that they've made it so disadvantaged to be a public company and so disadvantaged to raise public money that we're just bypassing that space and we're raising private money. And we're doing this in private kind of ways. And then it now takes on the point, which is what I was kind of implying with the private credit ETFs, that going public, whether it's an ETF or it's an IPO of a company, is like an exit strategy. In other words, you are my exit liquidity. And I am making this determination that this thing is now run its course. You can have it and good luck. I'm going to walk away from it right now. That wasn't the case before. That wasn't the case if you go back in the 80s and the 90s. When the Googles and when the Microsofts and stuff came public, they were very early stage companies. And when Amazon came public, there was still 1,000x left for the public to make in those. Now the 1,000x is made privately, and then they give it to the public after that. That's the problem with the alt space right now, is to try and figure out what are they pitching me to be their exit liquidity on versus what are they pitching me that's in the earlier stages of that. And just to give you one kind of mindset idea, that was the popularity of SPACs for a minute. And what was a SPAC before they kind of blew up was, I want to get in before the IPO. I want to get in a little bit earlier so I can enjoy some of that 1,000x move before we hand it off to the public. And so the SPAC was an idea to try and get in early. But then they turned that into exit liquidity too. And then that wound up being
There's still one that's pretty good, but I can't mention the initials because we'll get Rosie upset again. Rosie, what do you think about all this? I've been giving you a hard time over here. What are you feeling about markets today?
Well, I'll come back to what Charles said before, because it reminded me of Chuck Prince in July of 2007 when he famously said, you got to keep dancing till the music stops. And who knew back then that the music was going to stop 3 months later? So I don't know. I'm not really a market timer. And, we always hear that valuation is not a timing tool. Fair enough. However, the one valuation metric that goes back 100 years, that is a 10-year smooth multiple. So it covers the entire cycle. It's not just a 1 year forward, 1 year trailing, is the CAPE. The cyclically adjusted price earnings multiple. And right now, as of in January, the S&P 500 CAPE, well, you know what that number is, right? It's 37. Okay. So when was it last 37? December of 2021. And 2022 was not actually very benevolent year for a long-only equity manager. It was last year in 1999 and last year in 1929. So I hear that it's not a market timing tool, but it's either a headwind or a tailwind at any moment in time. But when you get to a 2.3 standard deviation event, now I want to make this point clear. Somebody mentioned before about the ratio of the U.S. stock market cap to the rest of the world. There is no other stock market in the world that is a 2.3 SD event right now, except for the S&P 500. So that classifies actually as an official price bubble, not a mania. We've morphed from a bull market mania into a bubble. And, Charles, did say that we have these 7 great companies, and they're great companies with business models and with cash flows. And I get this all the time. Well, you can't compare this to the quotes .com bubble of the mid to late 1990s. And I don't disagree with that, but it wasn't about pets.com. It was a broad, we called it TMT back then. Do you remember? Technology, media, telecom. It was a broad technology bubble. And we had great companies with great business models and great free cash flow back then. And they're around today. We had Microsoft. We had Intel. We had Cisco. We had IBM. Okay, we had all these companies, and they're still great companies. And they were great companies back then. But the problem is that their stock price wasn't so great. And then we had a mean reversion trade, as per Bob Farrell's rule number 1. And then their stock was in the penalty box even after the lows for 10 years. And they're great companies, and they're still around today. So I am pretty nervous about the stock market. I know I'm the boy who cried wolf, but remember that the wolf shows up at the end of the story. And then what is going to happen next? Here's what keeps me up at night from a societal standpoint, because we talk a lot about society. When you go to the Fed flow of funds data, you're going to see something we haven't seen before, which is that 70%, over 70% of the household financial asset mix is in equities. So not only now, basically roughly 10% is in bonds, and then the rest is in cash. This is doesn't include durable goods, doesn't include art, and doesn't include your real estate. It's the financial asset mix. This is a higher concentration of risk on household balance sheets than we had back in the late 1990s. It's unprecedented. And of course, what's happened, and which we didn't touch on, was the proliferation of these passive index funds. That when Vanguard first unveiled them back in the mid-1970s, we were told that this would never account for more than 20% of the market. That's what John Bogle told us, and it's now almost 60% of the market. All this proliferation and that's why active management is shrinking. But active managers get paid to beat the index. Hard to beat the index when it's so concentrated. You have this Mag 7, and they're, of course, always focused on risk-adjusted returns. Active fund managers are focused on risk-adjusted returns, but passive index investing is not risk-adjusted, okay? It is basically gross returns, not risk-adjusted. So I'm a little bit nervous that most people and the retail public has never been this involved in the stock market before. They don't even know what it is they own in their portfolio. At least when you had an active manager, you had these 15 or 20 stocks, and your broker would call you and talk about, I'm going to switch this and buy that. No, everybody is all in at the same time, and then they all think that they're going to be able to time the exit, which they won't. And there will be no bid on the other side. There'll be no liquidity. So I think the question we have to ask ourselves, which didn't come up, is why is Warren Buffett right now, for the first time in his professional career, sitting on 30% cash? What is he seeing that other people aren't seeing? And I hear it all the time. Warren Buffett, he's an old geezer. He's a Luddite. He doesn't get it. But remember that he also built up a huge cash position in the late 1990s when people said he doesn't know the first thing about technology. But he's a classic value investor, right? So price is what you pay. Value ultimately is what you get. And this is actually what underpins my bullish call on Treasuries, because I think there is going to be a forced asset mix shift. There'll be a forced flight to safety. Now, maybe, Jeff will think, well, 30-year bonds, that is not safe. However, there are particular characteristics, even in the maligned long bond, that other asset classes don't have, which is surety of payment, and there is no capital risk. Admittedly, there's duration risk. We can talk about inflation risk, but the bond market is a different animal than the stock market is. So we're at a, like I say, we're at a 2.3 SD event. And I'm going to tell you that when I talk about this with my clients, their eyes just glaze over. Like nobody gives a damn. But when we've been here before, bad things happened, not to the companies, but to their share price and their shareholders.
And then what you'll have is a CFO get on. I remember this during the GFC, come on and say, well, it was a 17 standard deviation event we experienced to the downside, which is impossible, by the way. Your vol's wrong, right? But
Can I connect one last dot, please?
please, and then we'll make this the final cut of this section before we go to the final section.
So let's just say Mr. Gundlach here is right, and that the unemployment rate's going to go from 4.246 up. And let's just say that this 2.3 standard deviation event might or might not lead to a serious correction in the stock market. Either outcome forces the Fed to lower rates to a greater extent than what the markets have priced in right now. I don't bring this up because of inflation or any other determinant of Fed policy, but Fed policy is reactive. Guy sitting by you, Jim Bianco, taught me that years ago. The Fed will react. So if there's a big correction in asset prices, the Fed will react. If there's a substantial increase in the unemployment rate, the Fed will react. But my question to leave everybody is like deep thoughts. What was that Saturday Night Live? Anyway, thank you. My question is, in 2001 and in 2007, what happened after the correction? What did the baby boomers have the ability to do back then? They had the ability to say, I'm going to work for 10 more years. I'm just going to make it back. 40% of U.S. equities are owned by individuals over the age of 70 years old. Okay? Your baby boomers are in their 70s. They own the stock market. What do they do if the Federal Reserve lowers interest rates and takes away the incredible income that they've been making, cash-free, 5.5%, 4.5%, whatever it is? What happens when that goes down for a generation that can no longer say, I'm going to go back into the workforce and work for another 10 years? That is not a physical option anymore. And then you start to talk about the Fed put dying, which are words I never thought would come out of my mouth. But it could be tested because of demographics and the inability when people, because 70 cents of every dollar of interest income is spent. 2 cents of every dollar of the wealth effect is spent. You take away the interest income, what are they going to do with their assets?
So you're saying I should sell my Carnival Cruise Lines now? I'm just saying.
I'll give you what they do. They call their son, works at DoubleLine, and say, hey, I need some help.
Dave was talking about active, passive, and active managers talk about risk-adjusted returns. It reminded me of something that happened to me in 1987. I had a client, and he was complaining about the returns weren't that much better than a passive index fund. And I did a presentation to him, and I said, we've got to think about this on a risk-adjusted basis because they're really strong. And he listened to me somewhat patiently, and he goes, risk schmisk.
1987, huh?
1987, of course.
The passive thing is a machine, though.
I did.
I mean, it really is a machine. People get paid. Money automatically goes into these funds. It automatically buys the most powerful stocks. Most powerful stocks go up. And even active managers that they want to keep same business, they have to chase them.
And that works as long as that 40% of stocks owned by the 70% isn't
Keep
touched.
dancing.
Yeah, no, I'm just saying it works. But I know some
It works until and then
well, it doesn't.
Yeah, and then what happens on the other side of the mountain?
Right.
Okay, as Herb Stein famously said, okay, anything that can last forever won't. So we can talk about this great machine. Of course, these index funds have to go fully invested. But what happens when we, God forbid, whatever, markets do not go up indefinitely. Right. And there's a lot at stake here because everybody is all in at the same time.
The passive, I'm just saying that for the fix is in until it's not.
We've taught everybody, you want to be diversified. Here's how to do it easily.
Except no one's really diversified.
That's right. The issue is the concentration has led to it. We had an event here, probably 10 months ago, and I talked about this and said that, you profess that you're buying this S&P that is so diversified. you really own the Qs
Right.
plus a little bit of the S&P, right? That's really what you own.
Right.
So admit it to yourself, go buy the Qs, go buy your, augment it with your Mag 7 and go buy some other stuff, right? Now, maybe that didn't work, Charles, because we didn't have it right. But the point is that we touted the benefits, but like everything else we do at Wall Street, we end up making it evil along the way, right? So with that, I'm going to stop there because I want to have the last word. It's not your show, Charles. So today,
I was a little confused for a moment.
no, but
That's why they get sparkling water. Now I know.
that's right. We were going to keep you hydrated, But with that, we're going to round up this section. You tune into the next section, which will be part 3, which will be the best